Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO, Shepherd Wealth Management. Very excited to be back here in home studios today, delivering the podcast. Ton of topics to talk about. Very excited. And as welcome back. I should say welcome myself back. I just got back from Florida.
Yeah.
Family lives down in Tampa. They just retired down there. Got to see the new place. It was a lot of fun. Weather was substantially better than it is here in the Midwest. We got like, I don't know, 40 something degrees, cold, wet, rainy. Just awful, man. Not that much fun. But I guess we chose to live here, so it's on us.
Did we choose it though, or did it choose us?
Yeah, it's weird because Cincinnati's definitely home. I live in Northern Kentucky. Would have been in Cincinnati my whole life. Love Cincinnati. It's always going to be home to me. But every time I go down south, man, it's like, why do we live here most of the time? You know, it's
I
way
do
better
know.
weather, and they don't have state taxes.
Yeah, I mean, taxes they're a pain. Some they're necessary sometimes, maybe. I'm not trying but for me the weather is 100% it. Every time I do a lot of work and also travel onto the West Coast and actually heading back there in about a week, as you know. And that's the same thing for me. It's just like I get out there with the weather and I'm just like, why on earth am I going back to Louisville, Kentucky?
Yeah, I'm with you. But anyways, it is good to be home. It is nice to be back at home. But you know, if I could choose, I didn't have to worry about school for kids. You know, grandparents that live around here locally and pulling family away and all that sort of stuff. Might be a different conversation here, but for now, you guys are going to get the podcast right here in home studios. For me, it's Northern Kentucky. For Ez at home there in Louisville. Very excited and the privilege to be able to bring this podcast to you all. The main reason why we do this, before we jump into all the topics of today, is I get a lot of questions from our customers, and a lot of these questions pertain to things that people see every day on their iPhones, their smartphones, the news itself, or wherever they consume content and news type of information. The news does a great job of telling you what's going on. Problem is that the news is in the business of selling ads primarily. They do like to do their news broadcast, I'm sure, but that broadcast is generally geared towards a couple of different human emotions that we're all hardwired with: fear and greed. The news broadcasters know this, of course, is that humans are hardwired with these emotions, and they know, based on behavioral finance studies, is that humans feel losses twice as much as they feel good about gains. So if you understand that, that would capture your attention twice as much about bad news as opposed to good news. And that's how they're able to sell all their advertisements. And they're not wrong by bringing that information to your attention, but what they do a bad job of, in my view, is giving you a lot of historical context, saying, yes, this is what the headline risk is, but don't worry too much because we've been through this, 17 other times in the last 50, 60 years. And here's what the outcome was 6, 9, 12 months later for the market and the various sectors, yada, yada. It's important to understand that to us because there's really only two things you can control when it comes to investing. One is, and I'd say the most important thing, Buffett would agree with this. Buffett famously said the number one reason individual investors do not achieve the results they should consistently is due to their temperament or lack of control of temperament, their emotions. So how do we get control over that? Well, we look at what history has to say under very similar circumstances. Well, once we understand what other human beings have done in the past, now we can put probabilities in our favor at least. Of course, past performance, not a guarantee of future results, and results can vary from historical precedents. Of course, investing involves risk, including risk of loss. But we're looking for probabilities, not guarantees. There's only certain things we can't control. The other one would be our asset allocation. So once I understand what humans have done in the past and I can put probabilities at least in my favor, I can now begin to manipulate that allocation. Asset allocation, by the way, is just a fancy way of saying this is how much of your money is invested in stocks, bonds, and cash. You have full control over that regardless of interest rates or political environment or whatever. And that's what's going to determine 94% of the variability of your performance over any given period of time that we want to look at. So we can control those two things. And that's how we go about controlling them, is looking at what history has to say, putting those probabilities in our favor, and then making a decision on when we're going to overweight and underweight. And that's what we're going to talk about today. We're going to talk about, first of all, some common tax questions I'm getting right now. I want to hit you guys with that. Maybe some common questions that you should be asking your advisor anyway. So kind of blend the two together there. And then we'll get into S&P 500 performance, some really cool historical data here. We have 5 months in a row of the S&P 500 showing positive gains. It's only happened a handful of times. I'm going to give you all that. I'm going to go over why we got fully invested last week. So when I was on vacation, vacation for me is still work days. I am on call 24/7, and Fed Chair Powell had an announcement last Wednesday before the market holiday on Friday. So Thursday, we got fully invested. I'm going to go over why we did that. I'm going to give some historical data relative to some of the overweights that we did make. And I'm going to wrap it up with our expectations kind of going forward here. And of course, we'll be doing this podcast every 2 weeks. And look forward to getting back on here again with you guys in a couple of weeks. So, is anything on top of your mind, my friend, before we jump into common tax questions? Anything I'm missing here?
No, let's rock. Let's do it.
All right. Question one: what's your approach to tax planning? Great, simple question. So first of all, what is tax planning? It's different than tax preparation. Your tax preparation is just gathering all the financial materials that we need to actually implement or execute a tax return. But tax planning is thinking about ways to reduce your total tax liability over multiple years, not just any 1 year. So great question, very simple. What's your approach to tax planning? So first of all, it always starts with the individual or the household, usually a couple, husband and wife, but it could be just an individual also, or maybe a business setting as well. So it could be for corporations, individuals, and households. The answer is generally the same, in that we want to have a conversation first. So I just want to get to know the individual or that business owner and their needs, what's important, what are the pain points that they've had relative to their taxes, why they feel like they've had those pain points. And once I get a pretty good understanding as to what's important to them, why, more importantly, it is important to them, we can begin to formulate some tax planning. And tax planning can be a lot of different things, such as setting up certain retirement accounts to maximize not only future retirement savings, but reducing your overall tax liability. It could be simple things like taking highly appreciated stocks that made a lot of money, like NVIDIA, as a great example. And if you're in a higher tax bracket, it could make some sense to gift those shares. There are things such as Roth conversions that we could do. If you have stock inside of a company 401k plan, this idea of net unrealized appreciation, huge tax advantage there. And I'm not going to get into the details of net unrealized appreciation or any one of those things, but there's not an unlimited number of things that we can do as far as tax planning is concerned, but there's a heck of a lot that can be done just based on one very simple type of conversation with an individual or business owner. So that's number one. And then secondarily, here at Shepherd Wealth Management, we surround our clients, not just with a CFP professional like myself, but we have our own CPAs scattered out throughout the country. We're working with folks in about 11 different states right now. And we have accountants in a couple of those different states. They're very well recognized CPAs and been doing this for a long time, extremely successfully. And we have those folks on call. So if there's something very specific that we're looking to get an answer for, implement, we want to make sure that we get a CPA's eyes on it real quick. I know exactly who I'm going to. Client doesn't have to wait. They don't have to schedule an appointment. We either bring them on the call right there, or we'll get the answer after the fact and go from there. So that's what we do. Number one. Second question, based on my personal situation, how can I improve my tax standing? We just talked about some of those things, making sure you're taking advantage of every credit and deduction available. And of course, we talked about different tax strategies already as far as Roth conversions, et cetera. But one thing that people simply miss, on their own is they have the ability to take losses and offset gains. And you can strategically do that. You can also strategically plan your withdrawals. So if you have a withdrawal coming up, let's just say, maybe Ez wants to go buy a new truck, sometime later in this year, say Q4 sometime.
I do.
What I might tell him, I'm like, hey, Ez, go ahead and finance the deal. And if you needed to take some money out of an account, you're going to trigger a taxable event. Let's say you're going to have to sell some shares, something to that effect, and you have capital gains taxes. Well, I might say, hey, Ez, since we're so close to the end of the year, just go ahead and take out what you absolutely minimally need and then take out the rest after January 1st, right? Very simple type of tax approach to that withdrawal strategy. And charitable giving is another one. We talked about that. And I just answered this question. Does it matter when I withdraw income from retirement accounts? Of course, it definitely matters. So if somebody was looking to, let's say, retire, and then they were going to take a portion of their IRA or their 401k, and that's how they were going to finance the down payment of a affordable, second home, something like that. Then I would tell them similar thing. Hey, why don't we take out a portion of that IRA here in this tax season? If we can wait another couple of weeks, let's say we're in October, November, something like that. I would say if we can wait a couple more weeks, then take out the rest after January 1st, kind of splitting up the tax liability over multiple different years. And that's kind of the big ones that I typically get from customers around this time of year. It does not need to be some big, long, elaborate type of meeting where we're sitting there for multiple hours going through all kinds of different tax returns from multiple different years. Yeah, we got CPAs that will definitely do that if necessary. But in general, taxes are a scary concept for a lot of individuals, which is why we have the professionals that we do to support. The implementation of these strategies is also to make sure we get the right information, and we're doing it compliantly for the IRS. And we're also taking all that liability off of customers' shoulders, right? They no longer have this anxiety of, am I doing the right thing? But they also have no anxiety of, well, what if the IRS comes knocking 5, 6 years later and they want me to provide some sort of evidence on whatever it is that they want to audit you on, right? They're putting all that liability on a competent CPA team that's preparing and filing and walking alongside us as we here at Shepherd Wealth Management implement, these tax strategies. And then we talk about them. If not annually, we sit down with customers every quarter to go over not just results, kind of talking about, hey, remember we talked about all this different, tax information. We're considering adding funds to a traditional IRA, but looking at, if we have a bad market year, maybe doing a Roth conversion for some of those, all kinds of stuff. So it's a constant conversation. Taxes are a moving target. We're potentially going to see some tax changes coming in 2025. But this needs to be an ongoing conversation with yourself. If you're doing this yourself, which I would not recommend doing taxes yourself. And there's a very good chance that most of you are too busy to be able to implement a very successful tax strategy alongside your asset allocation approach, which is why we are here at Shepherd Wealth Management. But hey, if you do have the time, you're a smart person, you can do your own research. You should still watch this show because we're going to give you the information that's going to put you down the path that will lead towards the type of research that you probably likely should want to do on your own. Now, shifting gears here a little bit. So getting out of the tax stuff, those are good questions from folks. And keep the questions coming, by the way. You can hit us up, 513-630-2664. Text me direct questions. You can also leave comments here on the YouTube page. And you can just simply go to shepherdwm.com. You can find all the information about myself, our company here, what we do for folks. We put blogs and podcasts and all the stuff right on our website. So a lot of ways to get a hold of us to ask questions. Now, I did want to talk about, as I mentioned here, we got 5 straight months, 5 months in a row of the S&P 500 being positive. And that hasn't happened all that much. So I did want to kind of share with you all some historical data relative to that. And I'm going to take this right from Yahoo Finance. So since 1950, there have been 30, since 1950, there have been 30 5-month streaks in the S&P 500, including the most recent one that we've had here today, along with another streak that ended last July. In all but 2 of the prior 28 cases, so 28 out of 30 times, the S&P 500 was higher 12 months later, with an average gain of 12.5%, which is a 93% win ratio. This compares to the average return of the S&P 500 being about 9% historically on average, and the S&P is generally up about 70% of the time on average. So when we get this type of bull market run 5 straight months in a row, which has happened 30 other times, it's not a lock, 93% win rate. I'll take those odds, which means I want to be fully invested. So when we talk about a shorter time frame here, right? So that's what we would expect over the next 12 months. But looking out 1 month, following a 5-month streak, the average historical return is 1%. So we should expect another 1% here on average in April, and that's a 76% win ratio under those circumstances where we got 5 month streak in the S&P. This is compared to the average on the S&P, which is about an average point or 0.7% gain with a 61% win ratio. So odds are in your favor right now to be fully invested based on this historical data. I'm going to give some very specific asset allocation approaches that we're taking here. But last Wednesday, as I mentioned, Jerome Powell came out, gave his announcement on the economy and expectations for future path of interest rates, right? And we were essentially as much as 50% cash for our customers leading into this meeting that happened last Wednesday when I was on vacation in Tampa Bay, Florida. And the reason why we had so much cash, first of all, we were not that heavy in cash to start the year. We were pretty much fully invested in January in the asset allocation that we were very comfortable with coming into the year. And then sometime in early February, we took a lot of profits off the table. We took gains from last year and the gains that we saw in January. We took them off the table. And the reason being, at that time, in January, the market was pricing in nearly 7 interest rate cuts, 7 25 basis point cuts throughout 2024. By the time we got to February, that number had been reduced to something like 3. And as we went into last Wednesday's meeting, that was still holding at 3 rate cuts. So when you go from 7 rate cuts in January down to 3, to me, that would generally mean that the market has mispriced stocks, right? Because you're using the path of interest rates as a discounting mechanism to figure out if something's fairly valued, overvalued, undervalued. And that's how the market works in general when it comes to pricing securities. And that's the hesitation that we have with remaining fully invested in early February and into last Wednesday's Fed meeting. But what we got during last Wednesday's meeting is a couple of very important things. Number one, Powell did not change his tone at all. He's still expecting 3 rate cuts this year. And that was actually shown in the dot plot, or what they call the economic summary projections. They're basically taking a poll from all the Fed members and saying, hey, throughout the rest of the year, where do you expect interest rates to go? So that dot plot didn't change from the prior month of February. Again, going from 7 rate cuts in January down to 3, and that did not change in last Wednesday's meeting. We're still expecting 3 rate cuts. Powell reiterated that, and we'll see what actually happens. It could be more than that. I would actually bet on the over. So if the market's anticipating 3 rate cuts based on what the Fed's saying, they're taking their word for it, I would actually take the over on that. I still am. But even if the Fed didn't do a rate cut at all, that would still be a good thing for equities. The only real big thing that would be a major problem for equities is all of a sudden we had to increase interest rates. That would not be a good thing. It would kind of blow up everything that I'm about to go over here. But we got 5 straight months of the S&P positive performance. That's good. I just gave you the historical data on that. And now that we know, based on last Wednesday, that the Fed has not changed their expectations for rate cuts this year, they just want to be a little bit more confident. And all that really means is you don't need to necessarily see, although it would be great to see inflation continue a accelerated path downwards. It's coming down. It's just been slowing itself downwards. It'd be great to see a reacceleration of that. But if we can just get the same sort of data coming in line with expectations or slightly better, that's a good thing. That leads to a potential rate cut at some point in time this year. And as we're sitting here right now, the Fed is expecting to meet in 27 days. That May meeting, May 1st, there's only about a 7% chance of a rate cut. I've been calling for a May cut at the beginning of this year. We'll get some inflation data next week, April 10th. We get CPI. Again, we'll get other data after that, but April 10th next week, CPI data is coming out. I'm expecting it to be below consensus expectations. That might tick up the probability of a rate cut in May just up a little bit, but I doubt it. But the June meeting, June 12th, there's about a 57% chance of a rate cut then. July, that number is about the same. And in September, we're looking at very similar numbers there as well. So at some point in time this year, coming up fairly soon, we do expect rate cuts. So that's the main reasons why we got fully invested. The market 5-month of S&P 500 performance positive. The market historically does great after that. We just went over that. And then Powell reiterated the future path of interest rates remaining unchanged, 3 cuts. and continued his dovish stance and being data independent. So that was everything that I needed to know to allow us to be fully invested, for our customers. Now the question is, with that information, what is the type of approach that we took? So I want to provide you guys a little bit of that today. And these are not recommendations for anybody listening to the show. I only make recommendations for my customers here at Shepherd Wealth Management. So you guys can do all of your own research. I'm just providing you with what we're looking at and kind of how we interpret it. You can interpret it however you like to. But a couple of things. So we talked about this at the very beginning of the year. Last year, actually, before we even get into the beginning of this year, last year, right around the middle of the year-ish, late summer, we were heavily exposed to the industrial sector. Now, the industrial sector is about 8% of the S&P or so. Right now, we're looking at something closer to 20% weighting in industrials. We've been this way, overweighting industrials, like I said, sometime last year, 2023, and we remain that way. So the real question is, why do we want to remain overweight industrials in this type of environment? So again, I look at history. PMIs, which is a metric for manufacturing data, which we just got that here this Monday. So when PMIs are less than 50, which they were in 2023, and rising, which they were, industrials see positive forward 6-month and 12-month gains, with the median gain being 12.6% over 6 months and 21.5% over 12 months. Yes, I mean, that pretty much sums it up right there. We wrote about this actually in a newsletter going all the way back. I think this is May. Yeah, this is May of last year. We wrote about this. So that's a big reason why we want to own industrials, because we just got the reading here on Monday, and PMIs came in at 51.9. So they were under 50 last year. Now they're over 50 again. They went from under 50 to rising. When that happens historically, you see a very nice 6 and 12-month forward return, both of which are above the S&P 500's average return. Most of my customers, not all, but a good chunk of them, are looking for performance that's better than the S&P. They're looking for that for a number of different reasons. Some of them are actually retired. Older folks that you might think shouldn't want to have that as a goal, but if they're already financially set, meaning they're receiving all the income they're ever going to need on a monthly basis, they have liquidity, they have this big pile of assets they're not actually using because they don't need to, their time horizon is actually a lot longer, because most of that money is likely going to go to their favorite charity or their kids or grandkids or a combination of all of the above. And if you're looking at it from that perspective, well, their kids and grandkids are going to live most likely a lot longer than their grandparents with all these assets. And if they're going to end up with most of this money, then their time horizon is huge. So that's why they're looking to grow these assets, even though they might be a little older. And we have clients that are still working also. So most of our clients in general are looking for performance that's slightly better than the S&P on average, as consistently as they can get it. And we've been able to deliver that thus far. But that's why we look at what history has to say, so we can overweight the right things, at least put the probabilities in our favor to give us a chance of outperforming the S&P. And this is exactly Buffett's approach that led to 60-something years of doubling the S&P's 500 performance. This is what he does. He's talking about the idea of diversification being for those who don't know what they're doing, right? There's only a handful of companies that are really worth overweighting at any one given point in time. Buffett owns 20 positions in his book at Berkshire Hathaway, but 80% of that money's in 5 names. So we don't need to make this any harder than necessary. So that's a big reason why we want to overweight industrials. I want to spend some time talking about small cap stuff. As I don't know if you noticed, CNBC, Fox News, pick your favorite news outlet that provides some sort of financial information. Pretty much everybody's asking the question, well, what about small caps? Should we overweight small caps? Should we underweight small caps? What are your, expectations for this asset class? And we wrote about this in January. I'm going to talk about it in detail now as our favorite asset class coming into the year from a performance standpoint. And I'm sure you probably heard about that, or at least seen it. I'm sure most of the people watching and listening to this have heard about, should we be in small caps or not?
Mm-hmm.
I'm about to drop some knowledge on you, Kath, as to why you should be. So here we go. Here. All right. We might see as much as a 50% upside. Right? I'm not saying that 50% is going to happen for small caps. I'm not making that very bold statement here, but you could see that. And I'm going to give you some historical reasons as to why that is. First of all, the Russell 2000, which is the small cap index, tickers IWM. Those are companies that are set to grow revenues and earnings per share faster than the S&P 500 by a larger margin. You're looking at median sales for small caps around 7% versus 5.5% for larger cap companies in the S&P 500. You're looking at a median earnings per share growth of almost 19% for small caps versus almost 12% for large caps in S&P. So that's number one. We do expect faster sales and EPS growth. Earnings per share growth may surprise many pundits who view smaller companies as growing slower. You're noticing this in the valuations of small caps versus large caps. Median price to earnings ratio for 2025 for small caps is 10% or 10 times, and for large cap companies in the S&P is nearly 17 times. So for those looking for value, things that if you're looking at the S&P saying it's overbought, too expensive, well, certainly small caps is a opposite of that. And we're also seeing the price to book discount for small cap companies being 44% less than the price to book for large cap companies. Now, why is this important? First of all, since 1999, this was the exact same launching point for 12 years of outperformance for small caps. From 1999 to 2011, small caps outperformed the S&P 500 by 650 basis points annually, or 6.5% annually, and a cumulative 113% outperformance versus the S&P. Exact same setup as what we have here today. And shouldn't small caps trade for a valuation premium relative to large cap companies, given the fact that they're still in growth mode? And wouldn't you also expect the price to book discount to not be so wide, 44% discount from large caps to small cap companies? And by the way, institutional investors have basically shunned small caps. They own next to zero small cap allocation, with $6 trillion still sitting on the sidelines for retail investors, right? There's a ton of liquidity, and there's a whole lot of reasons to want to be very overweight small caps. Last but not least, as interest rates fall, this is the type of asset class that should produce the best type of performance, given the fact that a lot of these smaller companies do in fact have to finance their business operations. So again, we go back to this discounting mechanism of interest rates coming down. Well, that would make the present value of all those future cash flows worth a lot more as that happens. So you would expect a reacceleration of small caps. And I think a lot of that dry powder, all that cash that institutional investors do not have in small caps, or retail investors just simply don't have at all in the market, a lot of that will re-enter the marketplace as we get closer and closer to that rate cut. And I want to be prepared for that. Small caps have kind of had this little mini stealth rally as of recently, and not seeing the type of outperformance that I think we're going to see. But I feel very comfortable looking at the historical data here. Small caps have underperformed for nearly, 13 to 15 years, something like that. But they have had very long stretches. We just gave you the numbers there, 99 to 2011, 12 years of significant outperformance. And it was a very, very similar setup as to what we have here today. So that's a big overweight for us, industrials and small caps. I'm not going to give you the overweight that we have on small caps. It'll probably freak a lot of you out, but just know it's substantial. We do expect some heavy performance coming from the smaller companies. Now we've gotten some opportunities here, to buy a lot of dips. So we've seen some volatility recently, and we are dip buyers. So again, last Wednesday we got Fed meeting. We were about 50% cash approximately across the portfolio. The very next day, when I wake up that Thursday, we are fully invested, heavy industrials, heavy small caps. And we're also playing derivatives of these two plays. So if we expect small caps to do well based on that data, they should do even better as rate cuts happen. Well, what also benefits when rates are being cut? A couple of very obvious ones to me. If you buy long-term bonds, you could do this through by owning a bond, just simply buying an ETF, ticker is TLT. And I'm not going to give you the weighting that we have for that, but if you're expecting rates to come down, well, if you have a bond that doesn't mature for 20 years and rates are coming down, that bond is worth more. So the actual ETF will go up in value. Those bonds are worth more money as rates come down. So to me, that's a no-brainer. That's kind of like a layup. That's just low-hanging fruit out there for people to, get a nice little return from. That's one derivative of an interest rate play. The other one that we mentioned earlier this year is housing. So we need about 5 million more homes than we presently have. That's not going to get solved this year. But as interest rates come down, the demand is obviously very high for housing, and people will be more willing to finance a housing build. Companies would be more comfortable with financing a housing build. It would make it a lot easier for banks to provide loans. Banks are 30% of that small cap index. All of these things are going to work together as interest rates come down, and we are overweighting them. Now, you might be asking, hey, you made a lot of money in tech last year for customers. Damn right we did. And we're proud of it. I still love tech. And the main reason why you guys should love tech as well is because it's solving a very, very specific problem. Tech is solving for the lack of enough human beings to perform a task. And this is not new to the marketplace. We've seen other instances where there's been labor shortages. And these labor shortages have lasted, multiple different periods of time. But if you're a publicly traded company and you have to report your earnings, every 3 months, well, you can't just sit around and wait for Congress to pass some immigration laws or, to get some sort of approval to clone human beings, which doesn't exist as far as I'm concerned. But tech as a sector is 30% of the S&P. It's one of 11 sectors. Tech is the largest. Healthcare is the second biggest at 15%. So comparing healthcare to tech, tech is twice the size, which means tech is dwarfing everything. Well, if you go back into like the 30s, when we had the Great Depression coming out of that, tech wasn't a sector at all. We were a finance, we had banks and we had manufacturing companies here in this country primarily. And how did tech become 30%? Well, again, over those periods of time, we wrote about this last April. If you can go to our website, shepherdwm.com, check out the April newsletter. This will be in there. Tech got to 30% of the weighting because it's solving that problem of there's not enough human beings to do this task, and we can't do it efficiently enough. And we don't want to wait around, so we'll figure out a way to use software or some sort of automation to perform this task. This is how tech got to the weighting that it got, and it's only going to accelerate. Artificial intelligence isn't just a buzzword. The problem that it's solving is we don't have enough humans to do a task, or we can't get human beings to do this efficiently enough. Therefore, artificial intelligence is going to overlap every area, all 11 sectors of the S&P. I think it's very likely that you see tech being something close to 50% of the S&P over the next 10 to 15 years. So yes, we still like tech, but we're more market weight tech right now. What does that mean? We want to own about 30% of our portfolio in technology. Last year, we had a substantial overweight in tech. We were 50+%, technology for a lot of different accounts, and that led to substantial outperformance across the board on average for our customers. So that's the reason why we look at all this historical data, is to put those probabilities in our favor and then make a decision with the asset allocations of what we want to overweight and underweight. So we are dip buyers. I gave you all the historical reasons as to why you would want to step into this market if you have been sitting in cash or being afraid to dip your toe. If you get a pullback of any kind, it's going to be a gift. You're going to get some pullbacks this year. Historically, we talked about this in the last podcast. We see about 3-5% pullbacks on average in any given year. We haven't had any of those yet so far this year. And I'm not calling for one anytime soon. So strength begets strength. A lot of people say the trend is your friend. As corny as that sounds, it's 100% true. So when you see something hit an all-time high, whether it's a stock, a sector, or the overall market, if somebody says, oh yeah, it's going to come down, so you might as well take your gains and win, they don't know a damn thing about the history of the market. Generally, when you see something hit an all-time high, there is no ceiling now. They don't have a resistance line. if you will, if you're looking at something like a chart or for technical analysis. It's never been shown that either the market, the stock, or a sector, once it hits an all-time high, just immediately does a reverse pivot. I defy you to show me something that would prove me wrong in that respect. So we were very bullish this year. We were very bullish all year. I was just looking for some confirmation on the future path of rates. We got that last Wednesday. I'm very excited to be a full participant in the market this year. I cannot wait to get into these quarterly reviews with customers starting today at 3:00 for me, and be kicking that off all month long here as we wrap up tax season. So that was everything that we wanted to cover today. We got some good tax questions, some awesome historical data. I gave you guys some specifics. Even though you're not customers, you're welcome. Let me know how that works out for you by the end of the year. And we'll look forward to doing this again in a couple of weeks. As anything we missed before we part ways?
No, we blew through this sucker, man.
All right. Well, enjoy March Madness. Go Reds. Doing well this year. I look forward to doing this again with you guys in a couple of weeks, right around the end of tax season, it looks like. And then we'll go from there. So until then, hope you guys have a great rest of your day. And enjoy yourselves. We'll see you soon.